Insurance Business TV was on site at the MGAA Conference 2025 and caught up with some of the sector's leading executives for its Big Question series. In this edition, we ask, how are recent regulatory changes impacting how you operate?
So recent regulatory issues around treating customers fairly, making sure the commissions that are being demanded on MGAA opportunities or broker opportunities are right for the customer, right for our profitability, represent good value to market, really.
Yeah, so regulatory issues are always going to be there, and they're always going to get a little bit more stringent. One of the things that we do within our system is that we, through the mapping and the validation process, we ensure that all the regulatory requirements are being met. So, for example, with the contract, we're making sure the limits, territories are all being adhered to. But I do think the regulatory is going to get more and more important as the market grows. So in London particularly, we're now seeing Lloyd's get interested in some of the organisations that are receiving data from MGAs, but aren't necessarily automating that correctly. So the regulator has a big part to play, and it's something that's going to get more onerous. And the only way to deal with it really is to automate the process.
So they're impacting us in a few ways. So we're a business that's going through a lot of growth. We're investing in growth in teams, whether it be program management, whether it be investments in our claims teams, in supporting growth. Really, our focus is on how do we partner really strongly. And so as we grow, we're investing in roles that specifically are there to support partners with regulation, whether that be getting our heads around maybe some of the changes that the FCA was talking about today in terms of changing some of the product governance regulations, right the way through to the important role we play on oversight. So even audit roles that can help partners really sharpen up what they're doing in terms of customer processes are equally important. So I think lots of people talk about the cost of regulation. That is a very real cost, that we're making sure that we invest in teams to support partners with it. And as ever, it's striking the balance between making sure that we take the regulation on as it's intended, which is there to drive good customer outcomes, but also, again, just balance it with making sure that MGAs in particular can serve the customers in the way that they want to.
Again, just actually coming from the conference from Matt Brewer's session. So one stat which is quite interesting, he has just over 100 people and he regulates 6,000 firms. So there has been some sort of music in the market that would MGAs be regulated separately because obviously they're not brokers, they are agents of capital. But what I think I would say is that what Matt has been very encouraging for us in terms of our relationship with him and our members is that if we identify through our members areas where there's unnecessary cost, duplication, requests for the same data on different areas, then that's something the association can play back to Matt and get his team to look at that and actually say, well, actually, you won't need to do that as an MGA sector. The second thing, actually, which is very topical because the consultation date closed yesterday, is the simplifying insurance consultation. And that has quite an impact on the market generally and MGAs. So a couple of examples. Clearly what the regulator is looking to do is to create, and I'll use Matt's phrase, a bright line, if possible, where if you're a consumer, you quite rightly get all that sort of protection you'd expect as a consumer buying insurance. But if you're a business and that you have a very professional broker actually advising you on that insurance program, the regulation in that section doesn't have to be the same as what it is of a consumer. So I think that's a great way sort of forward from a proportionate regulation. The other area which I'm aware that all of the trade associations, my peers have commented on is what's called around co-manufacturing. So the consultation suggested that either a Lloyd's syndicate or an insurer could be a lead manufacturer. What we've clearly sort of fed back along with the ABI, the LMA and BIBA is that actually MGAs should be able to be a lead manufacturer, not just the Lloyd's syndicate. And the reason behind that, if I may explain that, is that, capital deploys their balance sheet to MGAs who are absolutely experts in their sector, where actually that capital may not be an expert. So how that capital can be a lead manufacturer in a segment where they're not experts doesn't make any sense and could potentially lead to poor customer outcomes. So my view is that the MGA should be the lead manufacturer because they're the experts in that sector and whatever niche they're underwriting in.